What is a bond? Bond is a type of financial investment contract like any other contract that can be bought or sold as an asset. A bond promises periodic interest income at the coupon rate offered on the face of the bond. It is more like a loan investment for a period of time that a person can make with a company or governments in return for interest periodic revenue until the bond matures. You might have heard about the U.S. Treasury bills. These are issued by U.S. government and are traded on stock exchanges normally with a face value of $1,000. Suppose an investor 13 has $50,000. And he goes to stock exchange and purchases U.S. Treasury bills. At this time the investor holds the T-bills as contract for a loan asset investment. This investment is made with the government as government guarantees an interest on these bonds. In return for money invested, the investor will receive periodic interest payments being 5% of the face value of the bonds every year. This will be calculated as 5% of $50,000 equaling $2,500 per year that investor can save or invest somewhere else. Now let us see how to calculate the price of a bond. To do this we need the cash flows associated with bond, the maturity of the bond in years, and finally, the yield till maturity or YTM of the bonds as a discount rate. Suppose that a bond with face value of $1,000 pays a coupon of 5% annually will mature in 5 years. The YTM of the bond is 7%. As per the information, cash flows associated with bonds are coupon payments of $50 for 5 years and the repayment of principal amount at the end of year 5. By using discounted cash flows technique we can find the value of this bond. The discount rate for this purpose is YTM, that is 7%. We will simply multiply the coupon payments with discount factors, and by adding them up we will have the value of this bond equaling $918. Now the bond should be currently trading at a price of $918 at the stock exchange, but that is not the exact case all the times as the yield rates are continuously changing due to high trading volumes. Now let us understand the relationship between interest rates and bond prices. The bonds prices are changing every day due to the interest rates are changing. The companies are issuing more debt instruments and raising more capital, and the investors with different perceptions are buying and selling bonds on daily basis. Due to these trading activity, interest rates keeps on fluctuating and stock exchanges predict the yield curves periodically to value the bonds to control trade. The price of the bond is therefore affected by the change in interest rates. As a general trend and on mathematical basis, the bonds prices tend to increase as the interest rates fall below the coupon rate, and on the other hand the bonds prices fall below the par value as the interest rates increase. So as a conclusion, higher the interest rates, lower the price of the bond, and lower the interest rates, higher the prices of a bond.